Hey guys, it is Mark Kofer, 22nd of March here on a Thursday. So we are post FOMC. So I wanted to take a look at the E-minis and I wanted to look at some of this movement and kind of really understand where it was coming from. Um, we saw a breakdown start to occur closer to the 2800, and I want to look at that because it's something I've been mentioning in the videos, and where I really started to turn quite bearish S&Ps. And again, it was not yesterday, it was not the day before yesterday, it was last week up around this 2800 level, and really what gave me the signal. Essentially, you're failing at this 2800 level in an environment where we haven't seen for several years a lot of this bearish activity be embraced, and we're starting to see that more. And obviously, we've gotten a big rally from the February lows. But again, something we use in the room with the timing indicator, we start to go bearish here on a 4 hour. And this was great, and I watched this play out over the course of several days, right? So the idea that you're breaking bottom edges. Again, this is the 13th of March. Breaking bottom edges, tap back. So this is one of my favorite trades, the blow through tap back too. I know it can sound however you want, but the idea being that you break a level, it's the direction you break the level, tap back to that same level, right? That's the idea. And you just see the pattern repeat and repeat and repeat. And that's really what you're looking at. So this is a 4 hour look. And I know a lot of people in our space and in the retail space are looking a little shorter term. But I wanted to show you what it looks like on just even a 4 hour that I would describe as maybe more medium term activity to be analyzing here. I know a lot of people are even shorter term, so I'm going to take it down even tighter and show you what that looks like and where some of this movement occurs. But it's important as when you go back and forth to be able to say, well, what is my bigger picture telling me? So I'm just going to give you a look here. It's all I did was take it from a 4 hour. This is now on a 30 minute. And so the idea that on a 30 minute, you see the same levels, right? It's top edge, it's bottom edge, it's the same levels, top edge, bottom edge. You just see a slightly different picture because it takes more of these 30-minute candles to make it up, and that's all that's really going on. And so, one of the misconceptions a lot of people have is what time frame do you trade? It's not about a time frame, it's about a level. Again, this is what it looks like when you're breaking a bottom edge. You're tapping back to that edge, tapping back to that edge. So let's look at yesterday, post FOMC. What is the market reaction yesterday? Well, initially, um, you move lower, right? That's what happens initially. But look what gets broken. That's the key part. What gets broken? And I would define it again as edge. And what gets tapped back to, right? Edge, edge. Does this look familiar? Does this level look familiar yesterday when you break? Right? You trade back to the same area. Maybe not to the high tick, but you're trading to the same zone, right? That's what you're trading to. So that's the highs yesterday post FOMC. Now let's think about what happens when you take out the lows, right? It's a range, but you're continuing in one direction. All right, so now you're at your next edge, which is what? 2700. Those were the lows from the 19th of March. So we bounced. Here's FOMC. That's March 21st. And now we're into today. What do we break today? Right? All you think about what we're doing. We're looking at bottom edge action and look at the move through bottom edge. Now, this is early European hours. This is not US trading. This is early European. So certain people in the world are going to have access to that if they're up, and certain people are not yet started their days. But think about, again, what's going on. You're continuing to have a market that in the shorter term is controlled by the sellers. And that's the key component here. And so what I like to look at is even if you start to take this stuff down on shorter term, 5 minute, 10 minute, what you're starting to look for is the areas where the market will not show you higher or lower prices. That's what you're keying in on, right? So again, it's not the time frame, it's the level. I'm just going to highlight this area, this 2690 area. Right, so now I just went from a 4 hour to a 30 minute. Now I'm back to now I'm on a 5 minute. All E-minis, right? So think about what we're looking at here. Bottom edge. This is early US trading. Bottom edge, breaks bottom edge, 2681 lows. Where does it tap back to? That edge, right? That's at 10 o'clock. That's at 10 in the morning. And where does it do? It makes a move down to 66. Now it doesn't reach this edge. It doesn't reach this edge. All it does is comes back to this consolidation. That's where it comes. And in a market that's what I would call offered sell side market, you're not necessarily going to see best levels on every tap back. You got one here. The second opportunity was not able to reach it. Here's your next opportunity. Break of what? Bottom edge. Tap back to it. That's 26.65. The day closes just above 45. So there were multiple opportunities in that direction. So again, keep your eye on the levels and trade with that bias. It can be good stuff. So for the 22nd of March, it is Mark Coe. Cheers, and we'll chat with you all soon.